All right, we are looking at some positive performance to start the Friday trading session. And if you're a regular viewer, you'll know there's been this storyline of momentum for stocks heading into the end of the year. It raises all the obvious questions. Can the rally continue? And if it does, what's the portfolio positioning that would mean the best bang for your buck heading into 2024? I want to bring in one of our regular guests, JoAnne Feeney, partner and portfolio manager at Advisors Capital Management. JoAnne, it is great to see you as always. And as somebody who has a very good economic lens, what have you made of the market's interpretation of what the U.S. Federal Reserve is going to be doing in 2024?
Well, good morning, John. Nice to see you. I think that it's been quite a year in terms of how quickly in the United States inflation has come down, and the Fed's ability to signal, as it did recently, that current monetary policy is tight enough, and the dot plots suggested that under all the right conditions, there would be some cuts coming next year. Now, the market clearly has baked those cuts in and more because they're seeing the data too, especially today's data with the lower PCE inflation numbers as well. So clearly the Fed is making real progress on the inflation front. And at the same time, the strength of U.S. labor force participation, immigration has helped sustain GDP growth. It's been actually quite a stellar year in terms of the economy, which has been great for business.
So that's the macro analysis. Now let's go through different sector analysis. I want to start with the growth sector, which has had a huge run this year. And the obvious question that people debate is, well, hold on, these stocks had huge runs. I missed the rally. How can those names continue to add to the advance we've seen in 2023? What's your view on growth, and do you have any stocks within that sector that you actually like heading into 2024?
Yeah, John, I think people have to remember to look at all of the opportunities for investing out there. Certainly don't look just at the indices, don't look even at sectors, because the story of 23, as most people are aware by now, is that 7 companies, including Apple, Tesla, Microsoft, Amazon, et cetera, and NVIDIA have really been responsible for far more than half of the rise in the S&P 500, over 60%, in fact. And they're only 25, 30% of the index. I mean that's a big chunk in 7 companies. And so there are plenty of opportunities out there. Look beyond those 7 and you can find value. But even within those 7, we think there's good reason for the rally that we saw in those companies. You were talking earlier on the program about artificial intelligence. That has been a big part of the earnings story that has driven the opportunities, the earnings forecast for these companies higher, and that's very legitimate. And that's going to be a driver that's going to be with us for many years. So some of those, like Microsoft, for example, we continue to like. NVIDIA, we like in our growth strategy. Not for everybody, likely to be a bit more volatile than some are comfortable with. But then go outside of those. Look at Broadcom, which just completed its acquisition of VMware. Look at Cisco, which is being hurt right now because of a little bit of a slowdown in network build out, but very well positioned, and just acquired Splunk, which is a data analysis company that is going to be right in the middle of the AI movement. So there are a lot of opportunities in growth. We do think investors should continue to be exposed to growth. It's going to be the thing that powers the principle of their portfolios higher, but you've got to be able to pick and choose and avoid the companies where the rise might have not been so well grounded in earnings potential.
There's another kind of growth that investors are curious about, things like dividend growth, income opportunities. For our television audience, we have a board, and it's set on an income plus, and you had a few stocks that fit into that category. Tell us a little bit more about the names you like that would fit into how you describe it, income plus.
Yeah, so, we build specialized portfolios for our clients, right? Some of them are growth-oriented strategies, some are more balanced. But what we also like to do is put in a target for yield, because a lot of our clients are living on the income from their portfolios. And what we like to try to do is prevent them or minimize the amount that they have to sell shares to generate the income they need to live on. So we look for opportunities to bump up dividend yield. And now, of course, the fixed income side has been helping a lot. But in the dividend side, own companies that give you a higher than average yield. We've got a strategy that delivers 3%, 4%, 5%, different levels of yield for different folks. Philip Morris is a great example, very stable. Cisco, as I mentioned before, also a nice yield. Broadcom, a nice yield. So you can do both. You can get some income, which might help folks sleep at night, knowing that have that dividend coming in that can live on those dividends. But also you can tie that potentially with companies that also offer some appreciation. So yeah, income plus is a way that helps often clients sleep at night.
One of our guests earlier said she's at least looking at the options market for a little bit of protection. I mean, you never know, right? I saw a meme online about, the strategists making their 2024 year-end price targets. It was like throwing something up in the wind and it ends up like on the other side of the field or whatever. It's nobody knows the future. But I saw protection on your list as well. Is there a way to look for stocks that maybe give you a little bit of a hedge against some of the possible uncertainty that could lie ahead?
Yeah, I mean, there's certainly opportunities for protection. We do some of that. But what I was thinking in that list I gave you, John, was protection against a decline in the economy. I mean, we have gotten through 2023, fantastic. Labor markets are still strong, but there's always the chance. In fact, it's inevitable that we will run into a recession someday. Will we have it as part of the Fed's continuing fight against inflation? We don't know yet, but our crystal ball suggests that it's pretty far over the horizon if we're going to get that. But still, we think it's worthwhile to protect. One way to do that is against geopolitical risks, own some defense companies. Against recession risk, own some consumer staples companies, own some utilities. They do two things for you. They tend to hold up when the economy slows down, when budgets are tightening. We like McDonald's, we like TJ Maxx. It's the place people go to shop when they need to find bargains because their budgets are being tightened a little bit. They'll offer a nice dividend. And then, utilities tend to be more stable, and they were hurt this past year because of the rise in interest rates, the substitution into fixed income away from utilities, because they're similar kind of holdings. They don't offer a lot of growth, but they offer dividend. This year coming, if interest rates do fall, that's going to make utilities look better as that substitution effect wanes. And so there could be an opportunity for utilities not just to give you those moderate dividends, but also to see some appreciation, some recovery from what happened in the last year.